You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing,
I'm Deidre Woolard, an editor at Millionacres, and thank you so much for tuning into Millionacres Podcast. One of the questions we get a lot is about SDIRAs, that's self-directed IRAs. So people know that they can be used to invest in real estate, but when they think about the process, it can seem a bit daunting. So we're going to dive into that with John Bowens of Equity Trust. John's a senior manager at Equity Trust Company. He draws from 15 years in the real estate industry. He's got experience as an active real estate investor, and he's traveled all around the country. He's trained over 50,000 investors in how to understand SDIRA IRAs and really building tax-free wealth. So welcome.
Thank you, Deidre. Excited to be here. Excited to jump in for our audience today and teach a little bit on self-directed IRAs and how to invest in real estate and other alternatives.
Awesome. Well, let's start with the basics. What are the core benefits of SDIRAs?
Yeah, Deidre. So really, I break it down into three core benefits. The first, which I think a lot of your audience can relate to, is the ability to diversify beyond the traditional financial markets. So many investors, including myself, how I got involved in the business is I had an appetite to invest with my retirement accounts beyond ETFs, mutual funds, and a stock-based portfolio. In fact, many of our clients and many of the investors that I work with, including myself, we want to invest in real estate. We want to invest in something that's a little bit more tangible. Now, there are varying degrees of real estate investing. I've been plugged into the Millionacres podcast for quite a bit now, and there's a lot of discussion around real estate investment trusts, real estate private placements. Those are opportunities with a self-directed IRA, of course, but you can even go beyond that. You can invest in physical real estate where your IRA actually buys a rental property or does a fix and flip transaction, or maybe you're on the paper side of the business, I like to call it, where you're a private lender, where you're loaning money secured by real estate to other investors. In fact, my wife and I, we're landlords. We own rental property in our self-directed IRAs. And then as we generate cash flow, we have to do something with that cash. We don't want it to just sit there and earn little to no interest. So we deploy that to real estate investors that we've met in our local marketplace to fund their real estate renovation projects. So it's really there's a broad degree, if you will, of real estate investment options that you can participate in with your self-directed IRA or 401k. The second benefit are the tax advantages. And there are some accounts that grow tax deferred, and there are some accounts like a Roth IRA that grows tax free. But the core of this is that there's no tax return per se when you have a rental property in your self-directed IRA. It's like investing in a dividend paying stock with your IRA, which most people are familiar with. You buy a stock, your IRA holds that stock, dividend income comes in. You don't have to report any of those gains. You sell the stock, you don't have to report any of those gains. It's all in the tax exempt, tax deferred, or tax free account. Same goes for when you own real estate. So less paperwork, I like to say, and of course the benefit of what I call compounding interest in the absence of taxation. And then the last one, Deidre, is pretty simple, but a lot of people underestimate this, is that IRAs avoid probate. And I don't hear enough people talking about this. This is really, really powerful. And to put it into context for you, Deidre, and your audience here, I have a client out of St. Louis, Missouri, him and his wife, in fact. They started with about $100,000 in their Roth IRAs back in 2010. And over the course of the last 10 years, they've bought and sold over 20 houses. And they're buy and hold investors. They have 14 cash flowing properties now in their Roth IRAs, generating $139,000 tax-free every single year in cash flow that flows back into the Roth IRAs. They pay 0% tax, and they're over the age of 59 and a half, which is that qualified retirement age. So they have the ability to take tax-free withdrawals. And then beyond that, when they pass away, they're going to leave it to their children or grandchildren, and their children and grandchildren will pay 0% tax, and that IRA will avoid probate. So I know there was quite a bit there to unpack, But those are the three core benefits that we find investors are very attracted to with the self-directed IRA or 401k, whatever type of account they're looking to utilize.
Yeah, I think that last one is really interesting because you're absolutely right. It's not something that gets talked about a lot. We mostly focus when we're talking about SDIRAs or IRAs in general on the tax benefits. But you mentioned something else that I think is important too, which is the simplicity factor. Because if you're a rental property investor, the first time you try to file your taxes, it can be a little daunting. But explain a little bit more about how, when it's inside an SDIRA, you don't have to deal with as much of that. What about things like depreciation?
That's a great question, and it's a very common question as far as depreciation is concerned. How do I calculate it? Do I lose depreciation? That's usually one of the most common questions I get is, John, I was told at a seminar or online somewhere that it doesn't make sense to own rental properties with a self-directed IRA because I lose depreciation. Well, here's the way it works. When you own real estate, rental property in particular, outside of an IRA, you, yes, have the ability to write off depreciation known as a paper loss, and then obviously you have all your expenses. You file a Schedule E, and then in many instances, investors, including myself with my non-IRA properties, show a loss or very, very little income, so we have very little tax exposure. Well, the problem becomes when we eventually sell the property, all of that depreciation gets recaptured, and we then have to look at how that adjusts to our capital gain, our total capital gain, and then we have to pay long-term capital gains tax. Now, that's not necessarily a bad thing, but when we look at an IRA is a tax-exempt account. So if we go to Section 408, 401 of the Internal Revenue Code, for anyone that wants to look at this in more detail, you'll see that the IRA is a tax-exempt account. So just like when you invest in a dividend-paying stock, you don't have to report that dividend income. It's tax-exempt. It grows tax-deferred or tax-free, depending on whether you're using a traditional IRA or a Roth IRA. And then when you sell the stock, there's no long-term capital gains tax. So it works the same way when you have a rental property in your IRA. So the rental properties that I have in my self-directed IRAs and my wife's self-directed IRAs, all of the cash flow is tax-exempt. And we're using a Roth IRA for as many deals as we can. So that's tax-free. And then when we sell those properties, there's no long-term capital gains tax and there's no recapture depreciation. So we don't lose depreciation. It's because our IRAs are tax exempt, there's no income that's taxable for us to offset. And so it's important for investors to think about it through the lens of investing their IRAs into rental properties versus investing in the traditional financial markets. For a lot of the investors I work with, they can make a better rate of return and they feel more comfortable investing in rental properties with their IRA compared to a mutual fund, ETF, or other stock-based portfolio investment that they may currently be invested in now. So that's a great question, DJ. I'm glad you brought it up. In fact, I created a YouTube video on depreciation in real estate because it's come up as such a common question for so many investors across the country.
That makes sense. So you mentioned Roth IRAs versus traditional IRAs. Let's just go over what that is for people. And both of those can exist within the self-directed IRA format?
That's correct. So what folks will learn is you can self-direct just about any retirement plan. And it even goes beyond retirement accounts. There's also an account called a health savings account or a Coverdell education savings account that can be self-directed into real estate. And I think it's important for everybody to understand that self-directed is just an industry term. It just indicates to investors that they have the ability to use their funds and invest in real estate, mortgage notes, trust deeds, real estate partnerships, or other alternative investments. They're not forced into only investing in the traditional markets. So it's not a matter of legality, but rather a matter of choice. Some financial institutions will allow you to invest in real estate. Many, unfortunately, will not allow you to invest in real estate. And so that's one of our core competencies at Equity Trust is providing the tools, the resources, the custody solutions, the education for investors to be able to self-direct into real estate. Now, where I think you were going with that question, DJ, is what's the difference between a traditional IRA and a Roth IRA? Well, it's really simple. A traditional IRA is tax deferred. When you put money in, you get a tax deduction. It grows tax deferred, so you get all those benefits like we talked about when you have a rental property and you have rental income coming in and then you sell it and there's no capital gains tax. But then what happens with a traditional IRA is when you turn 59 and a half or older, which is the qualified retirement age, and you start taking money out of that traditional IRA, that's when you have to pay taxes. So quick example, if I grow a traditional IRA to $1 million and then at 59 and a half, I take a $100,000 distribution, that $100,000 is going to be added to my 1040 as ordinary income, and then I'm going to have to pay taxes accordingly. So if I'm at a 20% tax rate, 20% on 100,000 is 20,000. So I keep 80,000, but then I have to pay $20,000 in taxes. In contrast, a Roth IRA is funded with what we call after-tax dollars. The analogy we use in the industry is you either pay taxes on the seed or you pay taxes on the crop. So with a Roth IRA, we put money in after tax, no deduction. It grows tax-free, leveraging, again, what I call compounding interest in the absence of taxation. And then when we take money out after the qualified retirement age of 59 and a half, we pay 0% tax. The Roth IRA is one of the most powerful savings vehicles afforded to us by the federal government. And it is an incredibly underestimated tool, especially for real estate investors. And you could even take it one step further, because you could also, for real estate investors that are entrepreneurs, they're self-employed, they have lots of income, for example, a real estate agent or someone else that maybe they flip a lot of properties, they can actually look at a solo 401k, which has what's called a Roth component, where you can put substantially larger sums of money on an annual basis into that Roth component compared to a Roth IRA. So there are different vehicles here: Roth IRA, solo 401k with a Roth component. You got the traditional IRA. Everybody's a little different. Some people have 401ks and employer plans, and they roll those over into traditional IRAs and grow them tax deferred, and they're happy. Other people, they love this concept of tax-free dollars and a tax-free lifestyle, and they do their best to get as much money as they can into that Roth IRA or Roth 401k environment.
That makes sense. Now, I know that it's more than real estate that you can invest with in a self-directed IRA. Let's go over some of the other things that you can invest in and what you can't invest in.
Great question. So real estate, I think we've covered that, but I will mention that I've been using examples of rental properties and mortgage notes and trust deeds. I think it's also important, and I've spent a lot of time on the Millionacres content and podcast. A lot of investors like to invest in real estate syndications or private placement investments. And I think it's important to mention that you can do that as well with your IRA. And we see a lot of that type of activity. And there's a variety of ways in which you can use an IRA or solo 401k to invest in those opportunities. Beyond real estate as an asset class, you can use your self-directed IRA to invest in non-real estate private placements. So this is non-publicly traded stock. For example, I had a client many years ago, this is back in 2009, that wanted to invest in a social media platform. And you can imagine what social media platform this was, because it was in 2009 and it was before they went public. So they used their self-directed IRA to invest in privately held shares of this social media platform. Beyond that, you can invest in gold and silver. So a lot of our investors are what are called hard asset investors. They want physical real estate, they want real estate private placements, they want assets in their own backyard, and they want physical gold and silver. So that is an option as well with your self-directed IRA or 401k. And then last but not least, Deidre, I know in preparation you mentioned you wanted me to touch on this, is cryptocurrency. So for those that are interested in investing in digital assets like cryptocurrency, you can do that with your IRA. There's a variety of ways in which you can do that. Certainly, this is not all about equity trust. It's more about what you can do with a self-directed IRA with any organization. I will mention that we do have a technology platform that enables investors from point A to point B to be able to acquire cryptocurrency. Some custodians offer a fully integrated technology platform, and then other custodians might offer a system where you got to kind of go out and do everything on your own. You just want to do your due diligence to determine what's going to be the best fit for you. But you can absolutely invest in cryptocurrency with an IRA. And it, as you can imagine, has been very, very popular, I would say, over the last year and a half. We've seen a lot of activity in that particular marketplace.
What about NFTs? Has that also come up with people wanting to do that sort of similar?
It is getting a lot of questions around NFTs and some of the call it big 9 to big 10 coins. Pretty limited right now on what coins you can invest in with your IRA. As you can imagine, IRAs with all of these unique tax privileges, there's a lot of regulatory oversight. And what comes along with that is some limitations on what coins and, for example, like NFTs that would be available. What I will say is we are, because of the demand from the marketplace, looking at a variety of liquidity providers and a variety of solutions to try to provide a broader array of coins and assets for investors to participate in. So it's a constantly evolving marketplace for sure.
Oh yeah, I'm sure, and I bet that is only going to increase in interest over the next couple of years because it's we're still such early days on all of this.
Absolutely.
So, if someone wants to start an SDIRA. You mentioned earlier the process of the custodian. Can you explain a little bit more about what that is?
Yeah, absolutely. So we call ourselves custodians in the industry, and there are many out there. So equity trust, we're referred to as a directed custodian. Now think of equity trust just like any other financial institution. You have many out there. You can have an IRA, you open it up, you put money in. Maybe you have a 401k or a 403b or thrift savings plan. And usually those organizations, and there's nothing wrong with this, usually those organizations are only going to allow you to invest in traditional investments. If they do allow you to self-direct, you're only going to be able to self-direct into mutual funds, ETFs, stocks, bonds, traditional assets. So a what we call true self-directed IRA would be an IRA with a company like Equity Trust that allows you to invest in all of these unique alternative assets. And so really the first step is taking an inventory on what types of retirement plans you currently have and where those retirement plans are. Some people come from a occupation where they have a 401k or a 403b or a thrift savings plan if they work for the federal government, and they leave that company, and the natural progression is roll it over into an IRA, because where they're at now, they're not going to be able to invest in real estate. So they roll it over to a self-directed IRA, no taxes or penalties. That's one of the most common questions, Deidre, is, well, John, if I roll over or transfer my money into an equity trust self-directed IRA, are there going to be taxes and penalties? There are no taxes and penalties, so as long as you follow the right process. So once the money's over in the self-directed IRA, you could then begin investing in real estate. And we work with folks individually to make sure that we're rolling money over into the appropriate accounts. Some people have Roth IRAs, some people have SEP IRAs or traditional IRAs or 401ks. So it's a process there to get that money moved over into the self-directed IRA environment properly. And then from there, it's self-direction. It's entirely up to that investor on what they want to invest in, how they want to invest. They can invest in a variety of assets. They might have some real estate holdings and then some cryptocurrency and then a private placement investment. They're not forced into one path. They can choose what that path is and ultimately make changes to that path as they progress throughout their investor journey.
Interesting. Let's talk a little bit about those changes. So if you start, maybe you start with one rental property and then you want to add more properties or you want to go into crypto. What does that process look like? Can you add as much money as you want at any time? Can you move properties and assets directly in?
Yeah, so you would move cash over into the self-directed IRA. Now, some people have stocks and mutual funds and they're very loyal to those positions. They don't want to sell them. And so we do have the platforms to accommodate those assets to be able to be moved over in kind, and then they could be liquidated with equity trust. And now you have cash in the account to deploy that for your investment. You don't have to move all of your money. That's another common question is, John, can I just move over to equity trust what I want to get started to invest in some alternative assets? Absolutely. And then you can transfer more money over at a later date. So a lot of investors have IRAs or 401ks elsewhere, and so they're opening an account and then they're transferring or rolling over their funds to equity trust, and they could always go back if they want to take their cash from their equity trust IRA and move it back to a traditional brokerage that they're currently with. That's fine too. Again, this is for diversification purposes. And so then that leads us to contributions. So you can contribute to an IRA every year, and right now we're in 2021, so we can contribute up to $6,000 when we're under the age of 50 to an IRA. When we are 50 and over, we can contribute up to $7,000. Now that's just how much we take out of pocket and contribute to the account. But we can earn well beyond that $6,000 or $7,000. A great example is a client of mine recently did a real estate option, which I know I'm getting a little ahead of my skis here, but he did a real estate option where he put $2,000 down as an option on a self-storage facility flipped the contract to an investor buyer, and made a $20,000 profit, all tax-free in his Roth IRA. So you can go way beyond that $6,000 or $7,000 contribution in terms of rollovers or earnings in the plan, which I think is important. And then lastly, for someone that is self-employed and they have a solo 401k or maybe a SEP IRA, those are small business retirement plans that carry substantially higher contribution limits. For example, a solo 401k, when you're under the age of 50, you can contribute up to $19,500 a year. When you're 50 and over, up to $26,000. And it doesn't stop there because there's an employer deferral match, which can potentially allow you to get upwards of $58,000 when you're under the age of 50, up to $64,500 when you're 50 and over. And there is a possibility of getting that all into that Roth bucket of the plan. So that gets into kind of the more finite details, but Deidre, definitely important for folks to understand. Yes, there are contribution limits. There are some plans that will enable people to contribute more compared to other retirement plans.
Excellent. Thank you. So in terms of someone's trying to find a great custodian, do you feel like people should interview multiple potential custodians? What should they be looking out for when they're doing this, and how are the fees paid?
Yes, I'm representing a custodian here. I am an investor, and of course, just like I would whether I was buying a house or subscribing to whatever type of investor community, I'm going to look at researching a few different companies, 2 to 3 different companies. And so I encourage folks to do that, shop around, look at the different custodial providers and determine what their differences are. Some things that I would encourage folks to look at. Number one is the size and experience of the custodian. And certainly this is not a commercial for Equity Trust Company, but what I will tell you is in my experience, so I've been in the business for now 13 years, I've been in real estate for close to 20 years. And what I've learned in the self-directed IRA custodian / administration space, there are administrators and there are custodians. Now, custodians are regulated. So you'll hear they have a trust charter typically from South Dakota, as we do. They're bank regulated, if you will. So they have to adhere to some of the same requirements that a bank institution would. That's very, very important. I have heard countless times where investors set up an IRA or 401k with a company that is very small in terms of the number of employees, very small in terms of the assets under custody and the amount of transactions they do. And some of these companies, unfortunately, have failed. They've gone, if you will, into receivership, or there's been some sort of insolvency. In some cases, I've even seen fraud before. We've seen that in the industry. And then the customers that have accounts there are sort of left to try to figure out how to get their money and their assets and move it over to another custodian. And it creates a lot of problems for those individuals. So size, years of experience, those are very, very important. Just a couple facts about Equity Trust. We have $33 billion in assets under custody and administration. We have about 400 employees. So, we'd encourage folks to, check out other custodians, ask about, their customer service, the number of employees and their size. And then the last 2 items, Deidre, for people to ask about would be technology. So technology is really, really important today with self-directed IRAs. When I came into the business 13 years ago, it really wasn't. In the last 5 years, it's becoming more and more important. So do you have a technology platform that allows my renters to pay electronically? Do you have a technology platform that allows me to pay for expenses electronically? Do you have a prepaid debit card or credit card, if you will, that will allow me to pay for expenses for my rental properties? If I'm going to invest in a real estate syndication, what does that process look like online? And so you want to find a custodian that has an online technology platform that allows you to do everything from the comfort of your own home without having to manually fax or scan and email documents. And then I would say the last one, Deidre, and I get a lot of feedback when I go out to seminars and conferences and I do our virtual classroom sessions all across the country, is education and ongoing training. So there aren't a lot of firms out there that provide a lot of education and training to their clients and prospective clients. And so you're going to want to know what's happening in today's marketplace. What are people investing in? How do I use my self-directed IRA? What are the pipes? What's the pipes and plumbing? what are the nuts and bolts of the account and how does it work. And so that's something we're really proud of here at Equity Trust, is providing that ongoing training and education. A good example is I have a client that is doing master leasing with their self-directed IRA, which is a really interesting topic. Master leasing has been around for many years, but not so much with a self-directed IRA. And so just recently, I was putting together some content for some investors around how they can use their IRA to essentially rent a property and then turn around and sublease it on a minimum 1-month lease. And this Equity Trust client used their Roth IRA with about $22,800 into a deal in year one on a master lease agreement, taking control of real estate without ownership, and made an $8,400 tax-free profit in year one. So that's the type of education that we like to provide, is, what's actually working in today's marketplace.
That's fascinating. Well, let's take a quick break here.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
Have you realized capital gains this year? You can receive a tax break on your capital gains if you reinvest them in the Origin QOZ Fund 2, a private real estate investment that will be a diversified portfolio of ground-up multifamily developments. Some examples of assets that can be sold and the proceeds reinvested in the QOZ Fund are stocks, real estate, a private business, cryptocurrencies, and art. If you reinvest your capital gains in the QOZ fund, you can receive major tax benefits. In fact, an investment in the Origins QOZ fund can even boost your after-tax real estate returns by more than 75% as compared to a non-QOZ investment in similar properties. QOZ Fund 2 is offered by Origin Investments, a top decile fund manager who has executed more than $2.6 billion of real estate deals. Their first QOZ fund closed in July of 2021 after raising more than $265 million from over 800 investors. Go to origininvestments.com/millionacres to learn more about tax benefits of the QOZ program and to download your fund overview today.
I'm back with John Bowens, and we're talking SDIRAs and real estate. So in the first half, you mentioned syndications a bit. We have a service, Mogul. People invest in real estate crowdfunding deals, and they always ask us, can I use SDIRA capital? And some investors take it and some investors don't. But what should people who are doing those type of deals know about SDIRAs?
Yeah, so when investing your self-directed IRA into a real estate syndication, I would say the first most important part of the process is to make sure that the self-directed IRA is set up and funded. Many investment sponsors have very strict requirements on when the money is sent to the investment account. And if you miss that deadline, unfortunately, you may not receive your official received confirmed subscription. So you may fill out the subscription agreement and everything, and you have all your investor documents in line, but if you don't have that money wired to the investment sponsor in time, you may not, unfortunately, be involved in that deal. So you have to have the account set up and funded well in advance. And what I have found is a lot of 401k providers, 403b providers, TSP, IRAs, when you're transferring or rolling over from one account to another, Equity Trust, your custodian, is at the mercy of that other financial institution. And you can imagine, Deidre, people aren't willing to overnight send the money at a moment's notice for you to be able to fund your real estate transactions. So I've seen it take sometimes upwards of a month. So number one is certainly make sure the account is set up and funded well in advance. From there, we really encourage folks to make sure they're doing their own due diligence on the investment promoter. They're reviewing the prospectus or memorandum. They're talking to other investors. And they're doing, if you will, an overall due diligence review of that investment opportunity, because Equity Trust, as a custodian, we don't provide investment options. We don't review investments for merit or risks. And so it's important for that investor to do their own due diligence. So that would be the second one. And then last but not least, I would say important to look at the overall financial prospectus of the investment to determine if it's a good fit for your IRA, or if maybe you should make that particular investment with your non-IRA funds. My wife and I like to say it's a rising tide for us. We do deals inside of our self-directed IRAs, and we do deals outside of our self-directed IRAs. Some investments make a lot of sense for our self-directed IRAs, and other opportunities make more sense for our non-IRA funds. There is, like we talked about, depreciation. Maybe an investor wants to take advantage of some depreciation write-offs, and so they want to use their non-IRA for a particular deal, but maybe they're using their IRA for some private lending or note investments, which throw off interest income, and interest income can have a very high tax rate based on your ordinary income tax rate. So this is where the fun part comes into play, because as investors, we get to design our IRA portfolio and our non-IRA portfolio based on our specific needs and based on our specific tax situation.
I kind of love that you said the fun part right there, because I think a lot of people don't think of this as the fun part. They think of this as the most awful part, but you really can think of it as the fun part, because it is a way to think about your future and your investments and how you allocate things. Now, inside an IRA, there is sometimes a taxable event, right? So I've heard about UBIT and UDFI. Can you explain what that is? I know it's something that investors don't know a lot about and have heard some things that they might need to be like, they might have to pay money or something like that.
So grateful that you're asking me this, Deidre, because there's not a lot of information on UBIT tax. And for audience listeners and viewers that are thinking, what is UBIT? UBIT tax stands for Unrelated Business Income Tax. And it's this mysterious tax that no one knows about. Sometimes we like to call it IRA tax. So let's break it down. Unrelated business income tax applies to an IRA investment if one of two conditions are met. The first condition is if an IRA is engaging in an ongoing trade or business that's not substantially related to the primary purpose of the tax-exempt entity. So you're probably thinking, what is the primary purpose of the tax-exempt entity? Well, IRAs were really designed for passive investments, investing in things like rental properties, dividend-paying stocks, dividend-paying mutual funds, mortgage notes or trust deeds that look very close to a bond. So think passive investments where we buy an asset, we sell it, we get some long-term gains, maybe we do an occasional real estate flip. Where you could cross the line and be viewed as running your IRA as a business and then incur this unrelated business income tax is when you start, for example, flipping houses, or you might also hear people talk about flipping contracts, wholesaling, or doing real estate options. So these are short-term transactions where we buy, we add value, and then we sell, or maybe we buy and just resell simultaneously, or maybe it's a wholesale contract deal where we actually just put the property under contract and then we assign the contract. Those types of short-term transactions can trigger this unrelated business income tax. Now the question always becomes, well, John, how many can I do? We really can't tell you. Now the rule of thumb, it's a gray area. The rule of thumb that's used in the industry is you wouldn't want to do more than 2 short-term flips in your IRA, because if you do more than 2, then there's a strong likelihood that you could be viewed as your IRA is running itself like a business, or you're running your IRA like a business, and then you would incur this UBIT tax. Now, I know the question that people are probably thinking right now, well, what is the tax rate? Well, it follows the estate and trust tax schedule. So get ready for it. If you have income in 2021 in your IRA that's running itself like a business, income over $13,050, you're subject to a 37% tax rate. So take the ordinary income tax schedule, okay, and put a massive accelerator on it, and now you got the estate and trust tax schedule. So sounds really scary, all right? But good news is most people aren't doing deals that trigger this UBIT tax. All right, so then this leads us to the second circumstance, which is if our IRA engages in a leveraged real estate transaction. This comes up most importantly when people are investing in real estate syndications, which in 98% of cases, there's going to be debt leverage on those properties. So here's how it works. If our IRA buys a property and we get a loan, it has to be what's called a non-recourse loan, which means in the event of a default, the only recourse is against the subject property. Why? Because an IRA account holder can't sign a personal guarantee. So if you go and get a non-recourse loan, your IRA makes a down payment, you're going to trigger this unrelated business income tax. You'll also hear people refer to this as unrelated debt financed income tax. So quick example for people to really wrap their head around this, because I know this is confusing. Let's say I go to a non-recourse lender and I borrow $50,000 and I do a down payment of $50,000. So I'm buying a house for $100,000. I'm putting down $50,000 with my IRA. I'm borrowing $50,000 from a non-recourse lender. That could be a private lender, could be one of these bank non-recourse lenders. So my debt percentage is 50%. So what's going to happen is the IRS is going to say, hey, you can't take 100% of your net profit and put it back into the IRA and not pay any tax. Because you're leveraged under the provisions of Internal Revenue Code 511 to 514, you're going to have to pay tax on a percentage of that profit. And it's based on the percentage of the property that's debt financed. So let's say I made $5,000 in net profit. That would be after my depreciation and all my expenses. That's interesting. This is the one instance where you can actually take advantage of depreciation because you have tax liability. So after our depreciation, after our expenses, let's say we're at $5,000 in net income. So then we take 50% of that amount. So 50% of $5,000 is $2,500. So now we only have $2,500 in exposure. If we were 30% leveraged, then we would only have to use 30% as our figure. If we're only 20% leveraged, only 20%, so on and so forth. So in other words, as we pay down the debt, our exposure should become less and less. So in that example, I got $2,500 in exposure, and my first $1,000 is exempt. It's called a special deduction, leaving me about $1,500. At that tax bracket, I'm actually only at 10%. So 1,500 times 10%, you can do the math there. We would pay that amount in taxes for our unrelated business income tax. So now, last but not least, that was an example of my IRA owning a rental property where my IRA takes on the debt. Well, what if I did a fix and flip deal? If I did a fix and flip deal, obviously I'm most likely going to be making more than $13,050 in profit. Therefore, I'm going to be paying 37%. Not always a bad thing. I've had plenty of investors. A lot of people think UBIT is scary and I shouldn't do it. Plenty of investors leverage and do deals like this because they see the benefit of their IRA, even though it's paying taxes. Even after the taxes are paid, their return on investment is still quite substantial. A good example, investor that I know, his name is Tim. He's from Texas. He bought a house on owner financing with $5,000 down with his Roth, carried $50,000 in financing. So he was like nearly 100% leveraged. He fixed the property up, sold it, made a profit. He ended up making about $28,000 in profit. He had to pay his UBIT tax. At that time, it was actually 39%. Now it's a little bit lower, 37%. When it was all said and done, he still made about $21,000 tax-free in his Roth IRA, and he only had about $36,000 in the deal. So he actually made over a 50% cash-on-cash return on investment in 6 months on a fix and flip deal. So sometimes it still makes sense to pay taxes. And then, of course, using that debt-leveraged rental property example I mentioned, if your IRA is a partner in an LLC or limited partnership, so think apartment building syndications, IRAs investing in an LLC with many other investors is coming together to buy an apartment building. The operator is going to a senior debt partner, senior lenders lending money. In that circumstance, the unrelated business income tax actually carries its way through the K-1 reported to the IRA, and then the IRA has UBIT exposure. Now, you might have a lot of expenses and even be able to carry forward a loss. You got to pencil out the deal and see if it makes sense for your IRA. Plenty of investors use their IRAs to invest in real estate syndications. You just want to be aware of potentially having to pay that tax, whether it's during the years of cash flow or during the years where you actually exit the transaction and you're paid off. Tax document that you file is called a 990T tax return. So we encourage folks to get with their CPAs or tax pros to look at filing that 990T if it is necessary. If they don't have any income, they're showing no income, then they don't have to worry about it. But if they do, they would file a 990T tax return.
So, in terms of knowing if you're going to owe if you're going to owe UBIT, does it come from your CPA looking at what came in that year and the deals you did? Or do you find out some other way?
Yeah, best way for investors to know is looking at the K1. Look at the K1, which is a tax document that is issued by a sponsor of a LLC real estate syndication. All right, it's probably going to be their accountant, CPA, or somebody in their finance office if they're a large organization is going to issue a K1 to every investor. So what you'd want to do when you're analyzing the deal is talk to the investment sponsor, talk to their CPA, accountant, whoever in their office handles this, and say, can you tell me what the projected UBIT exposure will be on the K1? They can give you that information. And I'm sure there are a lot of other investors that are asking those questions as well, because we do find a large exposure of syndicators who are raising capital from IRA investors.
Well, and I know that sometimes if you've got multiple syndications going at the same time, they may be in different stages. So you could have one that's actually has a lot of losses right now, as it's maybe before the lease up stage, and then you might have one that actually has a lot of income because it's in the cash flow generating stage. So there is that possibility to kind of play one against another and kind of cancel out some of that, right?
That's a great point. You could absolutely look at it from that perspective, and I think that also goes back to our deals that are good for our IRA and deals that are good for our non-IRA investing. And so if you're, I call them serial apartment building syndicator investors or serial real estate private placement investors, people that just want to be totally passive. They don't want to own rentals. They don't want to do flips. They just want to invest in real estate partnerships. And there's a ton of opportunity there. And I think it's just a matter of looking at every deal and determining which ones are right for the IRA and which ones are not. And not having an incredible amount of fear of this UBIT. Many CPAs know about it. They know how to do the 990Ts. Some custodians will actually help their clients prepare the 990Ts and then they go and file it. We do provide those services here at Equity Trust Company. So there are resources out there. There are ways for folks to handle this. And really what it comes down to is analyzing the deal and saying, okay, what is my return on investment even after the taxes are paid compared to what I might be investing in the traditional financial markets? And if that amount is greater, it can still make a lot of sense for investors. One thing that I'll mention, Deidre, and you may have had prepared to ask me this, but I'll jump ahead a little bit, is folks oftentimes ask me, John, how do I avoid it? That's usually the question. How do I avoid this UBIT tax? And I kind of laugh and I say, well, it's like that. There's two things that are certain in life: death and taxes, right? I think it was Benjamin Franklin that said that, and that's the case here. You can't really avoid it. It's there, but if you qualify for a solo 401k, we talked a little bit about solo 401k. There's some unique advantage of being able to put a lot more money into that plan. With a solo 401k, there's a little known exemption under the provisions that would actually make you exempt from UBIT. So as long as the debt is structured properly. In my experience, 99% of real estate syndications, the way the debt is structured, your solo 401k would be exempt from UBIT. Now, that usually brings up from there, okay, John, that means every real estate investor should just open a solo 401k. Well, I would love if the rules allowed that. The problem is not every investor qualifies for a solo 401k, despite what many of these 401k promoters will say. They'll tell you just open up a solo 401k, don't worry about a business or income or anything, just open it up and put money in it. Well, the IRS guidelines clearly state that you have to make contributions that are recurring and substantial. In fact, 3 out of the last 5 years, you have to have made contributions. And if you don't have any earned income as a self-employed individual, or if you have an LLC or S Corp or corporation, if you don't have earned income that you're paying Medicare and Social Security tax on, you can't support contributions, which means you cannot have a solo 401k. So there's a lot to unpack there. I, of course, don't have time to go into great detail, but what I'll tell viewers and audience listeners is if you want to take advantage of that exemption, look at the solo 401k, research it. In fact, I have a YouTube video all on the solo 401k. You can check it out. But there's other resources out there as well. You can talk to your CPA, which I'd encourage you to do so, and make sure that you qualify. And maybe you don't qualify today, but you can structure your real estate business, and you as an entrepreneur, you can structure things so that you can have a solo 401k, and then you can roll over your existing retirement money into that solo 401k, make some healthy contributions, and take advantage of some of these this UBIT exemption.
Excellent. You mentioned the word fear, and I want to go back to that because people get so afraid of paying taxes and so afraid of dealing with the K1s that you mentioned that some of them say, I don't want to get involved in real estate investing. I don't want to get involved in an SDIRA. It's too complicated. What do you tell people when they have those kinds of fears?
Yeah, so the first one is IRAs, and let's use the example of a non-debt finance type transaction. My rental properties that I own in my self-directed IRAs, there's no Schedule E, there's no tax return, there's no reporting on my personal tax return. All the record keeping administration is actually handled through my Equity Trust online system. Everything's in a database, all the records. And so what's interesting is, even though some people look at it as more complicated, administratively, I actually do less for my self-directed IRA rentals than I do my non-IRA rentals. Because my non-IRA rentals, I got to have a CPA, I do depreciation, not necessarily always a CPA, but I do. You have depreciation schedules, you have to do all that calculation and those returns. With the IRA, I don't have to worry about any of that. Now, if I get involved in a debt leverage real estate transaction, yeah, I might have to file a 990T, but there's resources for that. CPAs know how to do this. You can work with your custodian that oftentimes will prepare a 990T for you. So there are resources. So although at first glance it may look a little opaque and more complex, what a lot of investors find in my experience is after they've done their first transaction and they realize how easy it is, at that point, it's okay, when do I get to do my next one and do a third and a fourth and a fifth? So I always tell people, if you're brand new to self-directed IRA investing, first transaction that you're going to do, you're going to need some hand-holding. You're probably going to need some help from your custodian like Equity Trust. That's okay. That's what we're here for. We actually encourage people to call us so that we can make it a good experience and we can walk them through that transaction. And then I think a lot of investors will find that might be a little fearful of this to start, that, hey, it's actually not all that complicated. I just got to do something different and something new that a lot of people find to be a little unorthodox.
Yeah, I think that's true. It's like anything in life. You have to get used to the new terminology and the new process. Do you have to report fair market valuation inside your SDIRA, right? How does that work?
Yeah, so what the IRS says is that on an annual basis, you are supposed to provide a valuation to your custodian on your non-standard investments. So non-stock market investments, they call them non-standard investments. Sometimes you hear them referred to as alternative investments. The IRS likes to use this term non-standard investment. So I think it's a standard investment, though. I don't like that nomenclature, right? I think real estate's the standard, all right, and stocks and mutual funds is like the non-standard. That's for me personally and a lot of my clients. But that aside, for your non-standard investments, you have to do some reporting in terms of the valuation. So properties are really easy. I get a broker price opinion from my broker. I send it into Equity Trust. They update the value. Now, once I turn 72 years old and have to take required minimum distributions from a traditional IRA, or if I convert from a traditional to a Roth, it becomes more important because there's a taxable event. But in the ordinary course of every single year, if we don't get a valuation update, then we just default to whatever the previous year's valuation is, assuming that that's what the current value of that asset is. So it's highly encouraged, of course, to submit valuations on an annual basis. It becomes more important when there's some sort of taxable event. Otherwise, year after year after year, as you're growing the account, there's no taxable event. You're not taking distributions, you're not converting. It's just income coming into the account, paying for expenses, buying new properties, investing in new assets, so on and so forth. When you're investing in real estate syndications, it's even easier because that syndicator is typically producing a quarterly statement or an annual statement that shows what the value is. In fact, we oftentimes set it up where that syndicator is just sending those statements to Equity Trust for all the IRA clients that are in our database. And then we get a master sheet that has all those valuations, and then we just populate all the accounts accordingly. So without the investors even knowing it, their values are being updated on an annual basis.
Oh, that's nice. So you have to do it yearly. What happens? I mean, this real estate market has been crazy. What happens when the value of your holdings goes up significantly? Is there any impact to you?
Great question. So just like a stock increases in value, no impact. The account would be valued according to your direction from your real estate agent or other professional that provides that valuation. So no tax implications. Obviously, the IRA is tax exempt, so no long-term capital gains tax or ordinary income taxes on your general income that's coming in from rents, or if it's a loan, interest income. So good news there. If you don't submit a valuation, that usually I get that question. What happens if we don't submit a valuation? Do you distribute our account? Are there taxes? Are there penalties? No, there's not. So there's no penalties if you don't do it. But it's, again, one of those things that is very much encouraged for custodians to tell investors to make sure that they submit valuation updates on an annual basis.
Fantastic. Okay, last question for you. One of the things that we keep hearing in the news is potential for tax changes. Wondering how you and the team at Equity Trust are thinking about some of those. I know there's been talk about the 1031 exchange, maybe some talk about IRA shifts. What are you hearing, and what are you advising people to think about?
Great question. I know it's on everybody's mind. So self-directed IRAs, there was some threatening legislation, if you will. And this was in the infrastructure part. I should say it's part of the Build Back Better Act. The infrastructure was just passed recently, as many people know. The Build Back Better had some self-directed IRA provisions, let's call it, that could have been catastrophic for self-directed IRAs. Now, rentals in IRAs, mortgage notes, trust deeds, 95% of what I work with investors on was not being threatened or impacted. And the reason why this all came about was because there was this Silicon Valley technology giant that used his Roth IRA with like $5,000 and grew it to billions of dollars. And so this then kicked into gear the government to say, hey, we need to do something about this. Well, by the way, what that person did was pretty much a prohibited transaction. All right, the law doesn't need to change to stop that. It was a self-dealing prohibited transaction. That being said, the reaction was we need to stop these people from abusing the IRA law. Not the person that's buying rentals, not the person that's investing in a real estate syndication. So there was some language that was put in this IRA provision proposal that could have been really bad for real estate investors. But again, for people that want to invest in rentals or make loans, there wasn't any problems. Here's where the problem came into play. The legislation proposed said that it would be a prohibited transaction, which means your IRA would be essentially distributed. If you invested in a syndication or a private security where the promoter would ask about your financial situation, your education. In other words, you hear of this term accredited investor or sophisticated investor. So if you were investing in a real estate private placement and that sponsor was reviewing you to determine whether you're accredited or not, to then determine whether you could invest or not, that would be considered a prohibited transaction. That's what they put into the law. Now, Deidre, good news. All of those IRA provisions were taken out. They were taken out of the Build Back Better. And this happened a couple weeks ago. Really good news. I can tell you Equity Trust, many industry professionals went to congressmen and women, went to the senators, went to the legislative folks and said, you need to get this out of here because you are going to create a massive vacuum with liquidity in the real estate investor marketplace. And so fortunately, they took that all out. That being said, there were a couple things that snuck their way back in recently. And at the time of recording this, at least, we don't know whether this will stay or not. So you want to make sure you depending on when you're listening to this, you read up further. But a couple things that snuck back into the Build Back Better, which will be up for a vote here coming soon. is IRAs, once they get to $10 million, the person will have to take out 50% of the value. Once they get to 20 million, they'll have to start taking all of it out and starting with Roth IRA money. So really sort of going after the Roth IRA. Again, they don't like the fact that billionaires are using Roth IRAs to invest in companies with little tiny amounts of money and then growing it very, very large. That's what they're trying to stop. They're not trying to stop me or you or a lot of the people on today's call from just simply growing their retirement plan at an appropriate pace, a pace beyond the stock market returns maybe, but a pace that's not the one day it's 5,000 and the next day it's $1 billion. And then lastly, Deidre, and this gets into an entire different seminar, but there's some rules around Roth conversions. So you can take money from your tax-deferred traditional IRA and convert it over to your Roth IRA, getting the taxes out of the way now so you don't have to pay it later. And what they're going to shut off is if you make too much money, you won't be able to convert from a traditional to a Roth starting next year. It's actually $400,000 and then $450,000 married filing jointly. So there's some of those nuances around Roth conversions that could change. Like I always say, I'm just trying to get to 10 million and 20 million. Once I get to 10 million, all right, I'll deal with it when I get there and when we cross that bridge. But so really good news. Self-directed IRAs are not going away, but there are some of those items that kind of snuck their way back in the legislation that we'll see what happens.
All right. Well, John, thank you so much for your time today. This was fantastic. Reminder for listeners, you can learn more at trustetc.com to learn more about equity trust. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discussed at Millionacres, or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.